All right, guys, we are ready to get rolling now. So my name is Drew. I'm with Staggered Equity along with Prav and Reshma. We're really excited everyone's here tonight. This is going to be a great opportunity for you just to kind of learn what we're doing, what we want to accomplish with the company, and what we're hoping we'll be able to provide you as an opportunity to grow. Just really quick, just wanted to let you know that Prav and Reshma have been doing this for a long time. They are tenacious in their desire to see this company really succeed. With that being said, I'm going to pass the mic off to Prav and let him actually do the presentation piece and introduce the company. But thank you all for being here. Can't stress how much we're excited to have you. All right, Prav, take it away.
Thank you, Drew. Thanks for the intro, and namaste and welcome everyone. And just a quick disclaimer, what we present here today is by no means solicitation for investment or sharing of an opportunity just yet. We'll get there, we'll be there, but just wanted to kind of let everybody know that this is an educational webinar and should be taking it that way. The other piece is we've been really excited and overwhelmed by your support and participation, and all the phone calls, emails that we've received in the past couple of weeks. Interest and your desire to learn more has really excited us. So thank you for that. If you have not already, please go ahead and go to our website and subscribe for our newsletter. We will have more of these coming up. And what we will also try to do is, based on our interaction here and other informal, formal interactions, we will try to cater and customize contents that suits you, and we'll provide those in coming days. The other thing we hope to bring is, Reshma and I have been doing this, but we're by no means experts in all things that goes into real estate. So what we hope to do in coming days is to bring experts that could enlighten all of us to be better and learn more. So without further ado, I'm going to maybe go ahead and Drew, if you can move us to the next slide. Drew mentioned, we've been doing this, but for those of you who have not had an opportunity to meet, my name is Prabuddha Dahal, by Prab, and I've been underwriting deals for my day job as a valuation for over 8 years now, and have underwritten over $800 million in real estate deals, primarily timberland and agriculture lands in 3 different continents, several countries. So when Reshma and we started, and we'll go over the company here a little bit, but today we wanted to just maybe share a little bit about what Staggered Equity Investment is, who we are, what we do, how we do it. And then I'll pass it on to the expert here, which is Reshma. She'll talk a little more about multifamily investments. What are the metrics that you should be looking at? What a real estate syndication is, as some of you may have known, some of you may not. What are the phases of syndication? What are distributions? And then we'll open it up for questions, because by that time, I'm sure you will have plenty. So, Drew, if you want to please go to the next slide. Staggered Equity was founded by myself and my partner, Reshma, here in Charlotte. Our company vision is actually twofold. First, we want to provide affordable housing for people that are otherwise struggling, right? There are a lot of people, and then there are affordable housing, but they're not the quality housing we think that makes a house for a lot of families. So that's one fold. So how we do that, we'll talk about it in a little bit. But that's one of our goals. The other goal is also to make these investment opportunities available, particularly to the broader community here, the community that we live in Charlotte and surrounding, and Nepali community, quite honestly, because we believe that our community has not participated in institutional level. I know a lot of a few of you who have participated individually, but at an institutional level of investments, which takes this investment opportunity, or real estate investment, to another level. We wanted to be that kind of bridge and provide that opportunity for you all. So we're committed to generating wealth through real estate investing, and not only providing you opportunity, we don't always have, we probably will not be able to fit all of you, all of your needs, all of your expectations, but we want to educate enough to where your investments are educated. You make your own decisions. That's another goal. And then we have, to be able to be successful in this field, as you know, we have a large network of experienced realtors, management team, marketing team. There's a lot of legal requirement, and Reshma will talk about SEC regulations in investments. So we have that network. So overall, that's who we are. Drew, can you please go on to the next slide? And what we do is basically, as I mentioned, when we underwrite these deals, we're first locating properties, single family, we've done a few, and then multifamily primarily that we're focused on now. That provides steady income, but also provides upside potential. So there's always those two things in mind when we're making these investment decisions or underwriting decisions, right? In the process of underwriting, we make an offer, we do due diligence, very thorough due diligence. And for financing, we syndicate, and then we talk to banks, our investors. There are other short-term, bridge loan providers and other entities, which we will go over time and have opportunity to discuss more on. And then once we underwrite it, we manage those properties to maximize the revenue, to optimize the performance of the property, and minimize the cost. And it's no rocket science. Those things are what helps in the performance, in the return, and eventually in the expectation of meeting the expectation of our investors, clients. We increase value, and that's where I say affordable. I said earlier, affordable housing, quality housing. We look for opportunities where if a apartment or a multifamily housing is run down, it's not up to the kind of general living condition, we will improve it to make it pleasant to stay and live in. And that's one of our goals, is to take on these. It's challenging, it requires investments, but we're happy to do that because it improves the condition of the house for people. Finally, any investment has to have a exit strategy, and we do too. So we look for refinancing, we look for opportunity to sell, and for those two, we're looking at the right timing and the right value. And that's how we hope to build the wealth for our investors. How we do it, we purchase properties with value-add opportunities. We finance 100% of renovation. So if you look at it, I mentioned we buy properties that may not be the best properties. And we may not want the best properties because then there's no upside potential. There's no upside opportunity. It's already priced. So we're looking for those, but we're financing the CapEx. That way, we do not come out of pocket. And Reshma will explain how the financing and leveraging works in the real estate here shortly. But we right-size the rent to market, because if you've improved property, likely you'll get a better rent. And then we'll sell or refinance when the opportunity is right. Just a quick metrics on some of what we are, where we're at in our journey, and we hope to be continuing and advancing in this journey with all the a lot of support and help from a lot of people in this call today. So we've got approximately 200 units we manage, about $10 million asset under management combined. So not all from Staggered, because Reshma and I did have prior experience with other properties that we managed and acquired. But in a short time, we've been successful to add significant deal to that 200 unit. We underwrite a lot of deals on a monthly basis. There's a lot that goes behind the scenes, but not everyone ends up in our kind of contract, if you will, or successful acquisition. And part of it is because we're patient, we're thorough, we're thoughtful. And, we underwrite a lot, but we are only successful in a few. Here's a little snapshot of where our current asset under management are, mostly concentrated in Charlotte metro area. But we've made a multifamily investment in Greensboro. And And we look at, within a few hours of driving distance, and part of it is so far we've had the philosophy where if we are going to invest, we will have to, get our foot and eyes on it. So that's kind of been our mantra so far, and hence the property is concentrated in and around where we live. With that, I think I'm going to hand it over to Reshma, who's more than capable to walk you guys or everybody, walk the audience here through some of the deals and how it works. Reshma, mic is yours.
All right. Thank you very much, Prof, for the generous introduction. Namaste, everyone, and thank you for joining. I'm very overwhelmed by all the support that we got for the webinar. Everybody seems to be very excited to learn. And as we grow and try to educate the community on this topic, we are happy to help you and answer any questions you have. But yeah, you can send that in the chat, or we will have a Q&A session later. Because of the amount of participation we have today, we had to mute everybody for now, but we will be done with slides shortly, and then you can ask any questions you have. All right. With that being said, I wanted to touch a little bit on multifamily, what it is and how it's different from single family for everybody who has been investing or trying to find the right time to invest. Single family and multifamily, even though it sounds like multifamily is nothing but a combination of single family, they are valued really differently when you're as an investor, right? When you're investing. So single family is mostly valued by CMA, which is comparable market analysis, which means if your neighbor is selling a house for a certain price, then it's more likely that your house will be valued at the same level. However, multifamily is valued based on the income that it generates, after all the expenses, there is a cap rate that's factored in, and that's how the multifamily is valued. Next slide, please. Okay, so just to give you a little bit of an overview, there's a gross income, which is the total everything, like all the income that a property generates, it's gross income. And there's a net operating income, which is also called NOI, which is nothing but the gross income minus all the operating expenses that you have for a property. This, however, does not include debt services or mortgage that you'll have to keep in mind, because that is also your expense, but it's not accounted for in NOI. Cap rate is the most commonly used financial metric in commercial real estate. So, net operating divided by fair market value is the cap rate. So if, let's say, a broker is asking for $10 million for an asset, and if it generates $750,000 in income, the cap rate would be 7.5%. If you move on to the next slide, I will show you a little more details on that. So this is an example of back of the envelope type thing that we do when we get a property from our brokers. Drew is our marketing director, so he brings in a lot of deals for us to look at every day. He is in constant contact with the brokers, wholesalers, and everybody and anybody who can get us deals. So this is how we basically underwrite them. So net operating income, if it's $750,000 with a market value of $10 million for the property, right? So the cap rate would be 7.5%. If you think about it, like if you have $100 and your one Apple stock is $100, then you can buy one Apple stock for your $100. However, real estate is a little different because the leveraging comes into picture, and you will be able to buy $10 million worth of asset with $7.5 million down, $2.5 million down, because 7.5 will be financed to the bank. So what it means is that if you had $100, you can buy something worth $400, because banks will actually help you get that property, and then you can make the money off the appreciation for $400, or in this case, $10 million. Okay, if we move on to the next slide, I'll show you a little bit more on the returns. Okay, so let's say we buy this property for $750,000, right? And over 3 years, if we are able to increase the NOI by 30%, so that's average net operating income by 30%, then because the multifamily is valued based on income, the price of that apartment complex or any commercial property would go up by 30%, which means now the property can be sold for 13 million, and the bank loan we had, if you remember from the previous slide, is 7.5 million. So if we had the rehab of 500,000, just the fixes, all the capex, and all the things that we did to the property, then we will have cash on hand that's 5 million, which is double the amount of money or cash we invested, which is 2.5 million. So if we are able to double the investments because of leveraging, because of bank, putting in 75% of the money, then our annualized return would be 24% in this investment. So, the best part about investing in multifamily or in general in any real estate is that you can get more for your buck, and leverage is the name of the game. We'll move on to next slide. Okay, so however, multifamily valuation is a little more sophisticated than single family. It's not based on speculations or anything like that. If you pay closer attention to the sheet right here, right? So that Excel, you will see there's a lot of data that we analyze. There's T12, there is pro forma, there is market values per square foot price, and all like unit mix and everything and anything that we get our hands on. So there's no gut feelings, and it's all data and all numbers. That is how we value our multifamily. So, to build this, we have our real estate brokers and the bankers who help us do these valuations, so that we can build the trust and the network of people who we work with. Okay, so if you're wondering who has the 2.5 million, or if it was $100 million deal, who has the $25 million cash to buy all these apartment complex that has, there's most of apartment complex in and around Charlotte or in the country is owned by this LLC, and this is how. So it's called syndication because there's different investors who come together and build a pool of money, right, for the acquisition of these apartments. So the $2.5 million might be raised by 5 people, 10 people. It will all depend on the LLC and how they build the team, and that is how they're able to acquire the property. And there is financing that's available for syndication purposes. This is not something we invented, or this is new. These have been going on for a really long time, and like I said, most apartment complexes in the country today is owned by syndicators or put together as a deal by syndicators. So I do wanted to talk a little bit about syndication phases. It's not as easy or simple as single family. It is a little more complex. There's formation, prospecting, fundraising, acquisition, operations, repositions, and exit. We will be doing a webinar on each of these topics, since it is a vast topic and there is so much to learn over there. But yeah, if you have any questions, do reach out and I'm happy to answer. I would, however, want to talk a little bit about how syndication is structured today. So there are general partners and limited partners in syndication deals. General partners are those who put together the deal, they find the investment, they enter the purchase and sales agreement. They basically put the earnest money down with no guarantee that they'll ever get it back if the deal falls through, right? So they are the ones who are taking the risk, doing the work, networking with people, hiring, so that they can find and put this deal together. Limited partners, however, will be, they are silent partners, right? They are passive investors. They really don't have much to do on the deal, but they are the part of distributions and will be responsible for the 25% of the purchase price. I also want to mention that all the syndicators do put the money in the deal and be a part of limited partnership as well, depending on their contribution. And so if we look at here, there are syndication distributions that have been done. And this slide, Prab, I think you would better explain it than I do.
All right. Just getting my video back so I can, there we go. Do you hear me? Okay. Um, so there's, basically, Resma explained how in multifamily there are levels of engagement by levels of investors, right? Limited partners are, by its name, limited because they are primarily what are driving a lot of the process. And usually the syndicators retain some of that limited partnership. And all the investors generally come in at general, I'm sorry, the other way around. General partners are the ones that are, have the have the kind of win on the hand, so they're doing acquisition, taking all the risks that Reshma mentioned, and the limited partners are, the limitation is on involvement and engagement more than on, there's still control, there's still share of equity, there's still, it's actually, share of equity is pretty regulated and proportional to their investment. But the general partnership comes in with some preferred benefits that the limited partners do not have, and part of that is because of the risks and efforts, including legal, financial, management, those type of things that Reshma mentioned earlier. Um, there are some. These are some of the examples. I mean, these are not set in stone by any means. Each deal is different. A lot of general partners, which are called GPs, they allocate certain level of benefits to people who are fundraisers, people who help in acquisition, entities who help in sourcing the deal. Not all deal come through real estate listings. There are relationships that people have built over time, and that's what we're getting into with Drew and in our team now. And there are some perks for those folks who go and put the boot on the ground, source the deals. So that's where some of these general partnership distributions come into fruition. Um, Again, the numbers here, I wouldn't, take a screenshot and go and try to build a contract out of. These are variable, but primarily, I think what you should know is there's two levels of engagement and benefits. There are preferred returns for investors, which are limited partners, before which the general partners normally do not, even take a penny. And then after those preferred returns are achieved, then that's when the general partners start getting a proportion of the distribution back. And it is staggered, you know, so is our name, in terms of what the preferred partners receive as compensation. It's just like any other large companies where there are performance-based returns. Here, the general partners seem to have those performance-based return at the time of acquisition, at the time of disposition. If the property makes a large profit for the limited partners, then a percentage of that profit goes to general partners. There are ways to become general partners in companies, and we'll dive into those later in other series. Next, Drew. Reshma, you want to put this all together for the group here?
Okay. I'm guessing I'm unmuted now. So yes. So this is an example of how, an investment would work. So if you look at here, you would realize that 20% of the services are paid to the syndicators, which are also called GPs, and the investors will hold the 80% of it, right? So this 20% is for the services they would provide, the asset management, property management, so on and so forth. And then the 80% will hold by the investors. Let's say if there is a purchase of $1 million, right, and loan would be 750,000, the LP share would be the rest 250,000. So if GP decides to get all that, half of that 250,000, then they will be 50% of LP while they are the GP. GP and LP are not defined by investment; they are defined by their roles, meaning they're actively in the deal, or they put that together, they're managing the asset, versus who is bringing the down payment for the acquisition. or in some cases all the cash if they pay all the cash for the acquisition. So, finding investment, entering in PSA, assigning the PSA, raising the money, and managing the investment is the primary goal or primary responsibility of syndicator. All right. And any questions?
I think I see a question typed on the chat room, so maybe we'll start with that. And
Okay.
feel free to, type in the question. And at some point, Drew, do we have, and pardon us, this is something that we are trying to learn and understand as well, but do the participants have a way to raise their hands so we can unmute them?
Yes, they do.
Okay,
So
perfect. That may be the way to go if you're not savvy in typing. But let me address the first question from Samji's iPhone. And namaste, and thank you for that question. At this point, I would say investments in the U.S. and especially in real estate is heavily regulated. That's not saying you cannot. There are actually programs that allow international investors particularly to participate. There are in U.S. regions where actually the U.S. government allows participants to invest, but there are certain asset class that has to generate certain employment. And at this point, we do not have any opportunities that are available for international, but knowing that you're interested, we will try to find and see if there's anything that would be eligible, something that you would be eligible to invest in. Hope that answers your question.
I would want to also add that there's like Prab said, right? There is a lot of different kind of investment, and we are just really getting started. Some people look at us like, oh, you have so much already. I don't know.
Recording in progress.
But then the thing is, we are really just getting started. Like we are looking for existing apartments and developments right now. But as we get into more ground up developing and building, there will be opportunities for international investors. Thank you.
Very well. The next question, I can take a stab at it, and Reshma, if you want to add to that. But John, thank you for that question, and appreciate your feedback on our presentation. So the interest rates, that's the topic, right? It is. And when the Feds released, or actually before the Feds even released their rates, when the market started to speculate on, and correctly so, they guessed it. I think they didn't hold that secret. We were worried. We were concerned that the interest rates would price us out of a lot of deals. And it's we're seeing it, we're feeling it, because the financing part, I mean, you're raising the question, and you know it very well. There's so much leveraging that goes on, and if there's a cap rate of 5% and your interest rate is 9 or 10%, forget about it. You're not even going to do a DSCR. Like you can't even cover your debt ratio. And so how do you do the deal? Well, unfortunately, fortunately, there are, always, deals that if an investor made this aggressive purchase last, 3 years back, and their note has come due, and they need to now refi or get hit with high rates, there are times when that would make more sense for them to dispose these properties. And we believe that there are properties, and we're actually looking at a few that are in that category, that we could find a very good deal. We have our interest rates in our underwriting. Our bank will not finance until they are convinced that the property will generate enough, income to cover the debt. So it's already factored in for us. And actually, we're seeing more and more deals come to the market at a, more or less reasonable rate than there was, say, in, 2020, 2021. Hope I answered your question.
Yeah. So in addition to that, I would like to, really emphasize on the fact that when we invest on things that are not leveraged, like stocks, NFT, bonds, whatever you invest in, you're the only person underwriting it, and you are the one who is taking the risk, and there's nobody really partnering with you. If you lose your money, you lose your money. If you lose your $30,000, you're probably not going to get it back, or you will wait for a long time to get it back. However, when we are underwriting the multifamily deals or commercial deals or any real estate deal, you know that your bank will underwrite it as critically because they are the 75% owner of the property, we being the 25%, right? So that's an additional, I find, as a bonus to invest in real estate, is because you have somebody
become available, we'll bring to the investors. And then you, if you're interested in investing with us, will decide what you want to invest in. So that's why I ask that you fill out the forms, stay in touch with us, talk to us about opportunities that we have on hand, and see if there's anything that interests you that you could invest with us. Or if you have a deal that you want to, get rid of, or, it's your maturity, the time of maturity, and you want to sell, we're happy to talk to you. If you want to buy some of our units, we're happy to talk to you.
Yes, it might be, I don't know, good time to sell as well. But
do you want to take that next question from Grishma?
Yes, sure.
Says, thank you for this webinar. How do we increase net operating income?
Okay. So there are multiple ways, right? The first thing is the capex. So all the improvements you put into the property will get your rent higher. That has been throughout until there is special scenarios. So that is one way to do it. Market rent goes up. If the population growth is more, it's just a supply demand thing that every year rent has been growing up in any market. So in like a lot of cases, you really don't have to do anything for rent to go up, which in turn will be your NOI. The other way to do it would be to decrease your expenses. We like to bring our in-house property managers so that we don't have to outsource it, on-site or full-time contractors who can work on the property, and things like that would increase your rent and decrease your expenses, which in turn will bump your NOI.
Very well. Thank you for that. I'm sorry I skipped a few questions here. Arjunji, thanks for the question. It's asking, do you have to be an accredited investor? So I think for a syndication deal, they are regulated, and we do have certain regulations. But every time we have an opportunity, we check out with our legal on the requirements and make sure that we are doing it with the correct pool of investors. So yeah, there are certain investments that will need to be from accredited investors, and there could be other investments that you may not have to be if you are just buying on your own behalf. Probably each deal is different, and there could be some deals that you may not have to be that. But for each deal, we do circle with our legal to make sure that we are covering the basis on legal front.
Yeah. Okay, so yeah, that's like, I don't know how much time you have, but that question is a very loaded question. So there are deals where you can invest if you're non-accredited, and then there is deals that are specific for them. But if we have prior, if you have prior relationship, I think you can. So
right. Yeah. The other question was, who does the evaluation of property? So Erica, thanks for that question. So when you ask evaluation, I'm going to go a little broader on not just financial. I think you're also asking other due diligence. So first is, like I mentioned, we set our eyes and foot on it. We look at it. We have a team, Drew, Reshma, myself, and we have real estate broker that, for different deals, we have different brokers. We go and look at the property, the condition of it, the market. We do analyze comps. We're looking at property performance, motivation of the sellers. Why are they selling? Why are they trying to get rid of the property? We do a number of other things. We even have sat in the parking lot for hours just looking at, what the traffic looks like, what the interest looks like in that property. We've knocked at, neighbors' doors and found out what the comps are when they are not listed. a lot of that goes in. And then on the financial side, we're a team. We do collect all the information that's available to us. We have a sophisticated model that we put together that looks into each and every aspect of both from the cost income side, but as you know, there are more cost line items than the income line items in the apartment and multifamily deal. So we look at each of those costs, make sure that those are reasonable, rational, and then we underwrite the deal. So it's a collective team effort all in.
Okay.
The next question is there a cap or limit you have to invest? Again, each deal is different. We've done deals that are in the few $100,000 to several $1,000,000, and depending on your ability, if you're an investor, there could be opportunity for you. Now, sometimes we have been on deals where the deals have been oversubscribed. What that means is there has been more interest from the capital source than the deal can accommodate. And then there have been other deals where we said maybe it's better to diversify among multiple investors. So each investment is different. I know that doesn't answer your question to the point, but I apologize. That's how it is. The best way would be to have a relationship with us so that we can understand what your investment goals are and we can find the deals, hopefully, that suits your need. But we will allow you to decide whether you want to invest or not on a particular deal, on a deal-by-deal basis.
Good answer.
All right. We are, looks like, on the Thai side. And Drew, I think folks are able to unmute themselves and ask questions at this point, right?
That is correct.
So if there's any, see if that works. If it doesn't, type something up and we'll make sure you're unmuted or raise your hands. Okay, hearing none, I guess we really appreciate the interest here and your time on a Thursday evening, on a weekday. Let us know how we did. Email us, call us, phone us, text us, or through our website. And, let's keep in touch. The other thing I wanted to request everyone is spread the words. And, this is something that we want to be able to, like I said before, we're not here to have you as investors. We are here to educate all of us and provide opportunities. But then I hope you would do your own way because you have the access to that. And we found it very, very difficult to find resource in a consolidated manner. We didn't have people who we could go to and talk to. So we started going to seminars, conferences, and then people are busy. There are, people that have been very successful and have very limited time. So we wanted to be present for the community, to ask questions, to learn, but also to learn for us as well on interests and, how we can all grow both financially and grow our wealth. So thank you so much, Reshma. I don't know if you have any further words, and then I'll let Drew kind of end it.
Yeah, so big shout out to Drew. He has been putting on a lot of long hours and late nights for us for this presentation. So thank you very much, Drew, and everybody who has helped us on this. Big shout out to my partner Prab, and he is so passionate about making community aware, and he has been in GCNA before, and we have been working together for a long time. His passion for community and my passion for real estate is what drives this company. So I hope this was a good use of your time, and we really, really appreciate you being here. Thank you very much.
Yeah, can't stress that enough. Thank you guys so very much.
Thank you. Hope to see you soon again. Stay tuned.
All right. Everyone have a good night.
Thank you.